Hello, hello, hello. What's going on, everybody? How's everybody doing today? Welcome to a capital hungry educational webinar on fundamental catalyst impacting factors on gold, US dollar, Japanese yen, equities, and oil. Now, the reason why we are focusing on these main trading instruments and investment vehicles is because this is what we primarily focus on in trade within the capital hungry service. Majority of people are trading gold itself. They're trading US dollar pairs, Japanese yen pairs, various equity markets like US 30 or the UK equity markets, trading oil. And also from a fundamental perspective, when you look at the web of the financial markets, the more you see the common denominators of impacting factors, and also how a lot of these work hand in hand in terms of the order flow movement throughout the markets, the more you will learn to understand and adapt to the various market waves and economic cycles and have a better understanding of what's going on, more confidence, and so forth. Now, the points listed out within this webinar, I was literally just sitting here and was on Canva, like this little graphic creating program, and I just started to make this presentation. This is not encompassing every single financial market impacting factor on these various trading instruments, but it is holding a lot of information for us as manual retail traders, of information we can go out and find that you don't necessarily have to pay for. You can find this information, monitor it, assess the impact, and use it accordingly within your trading. Okay. So today, what we'll be learning today is some fundamental impacting factors and just some overall background information on gold, US dollar, Japanese yen, oil, and equities, not in that particular order. But what I want everyone to understand is this is going to be added to the educational webinar library, but we've already done tons of other webinars on these topics. This is just to further highlight on these topics and present it in a different fashion to help people understand and absorb the information a bit better. And of course, if you can use this hand in hand with the other information we have shared on the charts, and I'll be doing that through this as well after we go through this little PowerPoint of giving the chart examples, the historical examples, economic cycle examples, and so forth. So let's start off here with gold. The reason why I want to go through this is because as manual retail traders, if you're very ignorant to the overall market knowledge, it's very easy to get lost in the charts from a psychological perspective and not even have a singular clue of what this thing is you are trading. What is this XAU USD? Why is the price moving the way it is? Why is it doing this on the higher time frame? Why is it doing this on the lower time frame? What is this really, right? And more people are getting introduced to the financial markets with less and less understanding of economics, fundamentals, and so forth, right? So we all have to understand that gold within itself is a global titan in the financial markets. And regardless of what people may say, as time starts to progress and crypto comes out, or they develop blockchain, or new markets start to emerge, gold has gold has held its value and stood the test of time. Gold has been used in itself as an exchange of currency historically, back in the day, where you used to actually need to have gold coins or gold bricks to go and purchase something in the local market in that value exchange. It has been used to back currency in recent economic history, even in the US before they left the gold and silver backing standard. At one point in time, through majority of economies, currency was backed by actual amounts of gold that that country had in value. So you couldn't just go out and increase the money supply willy-nilly. You had to have the actual gold to back it up, right? Gold is an investment vehicle in itself. It's used in technology, industries, and so many other avenues. So we have to understand that from our perspective as manual retail traders, you can't just get so zoomed in, especially for a lot of people who will scalp gold or day trade it, thinking that, oh man, gold is hunting my orders. Oh man, gold is going after me. Gold's so vicious to trade today. It's not just the trading market itself or that order flow that is impacting the price movement of gold spot that we see on the screen. It's not just that. There's tons and tons of other factors and real world impacting factors that we're going to go through in a second that impact the price of gold. Okay. So some good reminding factors is gold is a precious metal, held its value through the test of time, and because of that, it's also treated as an economic safe haven. What is a safe haven in terms of investor jargon and talk there? Well, it is an area in terms of the financial market where investors move their liquidity, they move their money and capital to keep it safe during times of uncertainty, doubt, or fear that can obviously be different based on circumstance, right? But overall, when you have uncertainty, doubt, and fear within the markets, you see investors and smart money looking to hedge against the risk of that uncertainty, doubt, and fear and pool into safe havens. And gold has been treated like an economic safe haven through history, okay? Now, gold is globally hoarded, mined out of the earth, refined and produced into the bars, and hoarded by countries and central banks and the country's governments and so forth. You can go check yourself the purchases that various major players such as Russia or China, the US or UK, how much gold they purchase every month or every year. You can go check out how many pounds of gold or dollar value of gold they keep in their reserves that they're publicly reporting, right? It's not just this random price on a chart that we're watching. This is a physical asset class that is being hoarded by major market makers in Wales because of the value it sustains on an economic standpoint, okay? Now, outside of trading, outside of hoarding it for its value, gold is also actively used in electronics, computer chips, jewelry, and so forth, which is billion-dollar industries in itself, right? So gold has actual active uses within economies. Like we talked about, it's held its value historically through time. There is scarcity, however you want to pronounce it, involved with gold. There's only so much of gold within the earth until they start developing the space mining further and mining asteroids. There's only so much gold that there's actively within the earth, right? So it does have a certain limited supply to it, and there's no infinite amount to it, which would completely deplete the value when you're looking at economics and the basics of supply and demand. And gold within itself, like we do, is an investment vehicle. Whether you're investing in it long term, you are holding it for the last period of years, whether you day trade it, scalp it, it's an investment vehicle. The price movements in itself are actively traded. So you have retail order flow entering the market of gold, which is very minimal. You have the order flow of institutions, market makers, and so forth, right? And then you also cannot forget the central bank policy positioning and impacting factors, which we saw heavily impact gold price over the last 2 years. So when you understand that and you dive into the impact, or when you dive into understanding what gold is, how it's observed within our economies, how it's been used historically, what type of actual real world uses it has in its supply and demand, then you can get a better understanding of its impacting factors. For example, the production and mining cost is a huge impacting factor on gold. And a very interesting story I'm going to tell you guys as well. But a great example to give of this is one of the reasons gold was so bullish over the last 2 years was yes, especially at the start of the pandemic, right? One of the reasons gold was so bullish at the start of the pandemic was not just because of inflation starting to rise, and yes, of course, the lower interest rates and the fear, uncertainty, and doubt, but in the real world, outside of these screens and charts, the global lockdowns led to a shutdown of various gold production mines and facilities. So gold's supply was being impacted, and you had a decrease in the supply availability, as well as in the availability of actually transporting and shipping the gold, because you had countries closing off their borders, countries' economies were locked down, these various mines were suspended, were suspended or shut down temporarily. Let me see if I can find that actually. I can't find it right now, but I talked about it in another webinar where we were showing at the start of the pandemic where we had a hotspot of around the world and tons of various gold mines being suspended or shut down due to the lockdowns. So basic economics, when you have a low supply for something or limited amount of availability for something, but a huge demand, you saw gold price explode in value, right? It would also be if there was some revolutionary technology that comes out that made gold mining a fraction of the cost. Now mining is a lot cheaper, production is a lot cheaper. That would also bring the value down of gold. That's just that obviously doesn't exist at the moment, but that is just an example, right? That goes in and ties hand in hand with the supply and demand. A great example of this is, of course, the pandemic. You had lockdowns, which shut down global mines, bringing some more scarcity to the supply. But because the globe was in a pandemic state and the market fear, uncertainty, and doubt was high, the demand for gold at that time was higher. Lower supply, higher demand, you have an increase in gold value. Okay. Interest rates. The majority of gold investing is done through a positional perspective, and majority are holding for months to years after these gold cycles are happening and the corrective phases take place. For example, the 2008 financial crash, when gold did that rally from the low $700 an ounce all the way up to $1,800 an ounce, it was from 2008 to about 2011, 2012, before we saw the correction years later. What makes it very favorable to keep pooling into gold and holding it for that period of time as an investment vehicle, because these institutions have to pay on these holds, loans, and investments that they're holding longer term, is having lower interest rates. It's like having a mortgage on a house, and for a period of years, the interest rates are much lower. So you're essentially paying less on that money owed, which is more favorable to be buying into houses at that time or having a mortgage at that time when interest rates are lower, right? And same thing when interest rates rise. This is a bearish impacting factor on gold, as it's the counter impacting factor as to the interest rates being low, right? It's no longer a favorable investment opportunity when the rates are much higher, and more times than not, when you look at the repeating cycles in history, whenever interest rates are going to start to rise or are higher, the price of gold is already higher as well. So you have more unfavorable buying conditions, which is a higher price and higher rates. Okay. Inflation is going to be common across the board, because economic inflation impacts everything within an economy. If inflation is rising, it's also going to impact and inflate the price of gold as an asset class, a part of the US economy, global economies as well. Okay. Now, remember, gold is a safe haven. So market sentiment, fear, uncertainty, and doubt is a major impacting factor, especially on the intraday movement of gold. At the end of the day, everything we are talking about within this presentation is a investment vehicle or trading instrument that's going to have trader or investor order flow, with this being a common denominator that's being impacted based on the impacting factors stated, right? So as a safe haven, any types of changes in economic fear, uncertainty, and doubt, it could be things like huge amounts of investor focus on a political catalyst like Brexit. It could be economic trade wars between countries like major players like China and the US. It could be real world war tensions starting to develop, like if Ukraine and Russia starts to escalate, or any of the Middle Eastern tensions we've seen before in history, or even before the pandemic when Iran and US was heating up, and that kept gold and oil very bullish at that time as well. So market fear, uncertainty, and doubt, and overall market sentiment is a major impacting factor on gold's price. Then on top of the investor and trader order flow, you actually have the physical buying and selling of the actual gold. If it's going to be through the production, if it's going to be used in the manufacturing or production of electronics, jewelry, hoarding the gold, and so forth, right? So that is another impacting factor in itself. A lot of these we can't even really see, especially from our retail trading perspective. I just want you to be aware of this and have that knowledge that gold isn't just looking at your broker account. Gold isn't just following one singular thing. The financial markets are extremely vast and huge. Yes, there's some main macro catalysts that we can use as retail traders as tools of information to observe and assess gold movement and potentially predict what's going to come, like you've seen us use many, many times before, such as interest rates, inflation, fear, uncertainty, and doubt, overall order flow movement when we analyze market structure, economic cycles of crisis, and so forth. But I want you all as traders, especially who are learning the fundamentals, to really have an understanding of what you are trading, to have that bird's eye view, to really understand how small we are as retail traders and what we are really getting ourselves involved in. But nonetheless, you see in real time when we do our intraday analysis, when we do our higher time frame analysis, a lot of these factors that we do use within our analysis in our trading. Okay. Okay, now crude oil, just like gold, just like the currencies, like stock markets and so forth, crude oil is a major economic pillar. But more than that, crude oil is a global power and control tool and a needed resource. Economies do not exist without oil. If you take oil away from a country, if you take the oil away from a country, it will crumble. Oil is used in industry, manufacturing, plastics, transportation, heating, electricity, petroleum products, and the list goes on and on, right? As much as they want to say in mainstream media and like to the public that they're transitioning to clean energy sources, the amount of dependency that global economies have on oil is absolutely insane if you did any further research into it, right? The billions of cars on the road, the amount of houses being heated through oil, industries, manufacturing plants, factories, production lines, so forth. It's crazy, okay? Countries that are rich in oil or control, or so your country doesn't just have to be rich in oil, but if your country controls oil-rich areas, historically become very powerful if they sustain that power, which is usually a high probability done through physical violence force or economic force. Physical violence force, of course, being war, and economic force being things such as major countries and players putting sanctions on smaller countries to potentially have an economic, to destabilize that country, then have an economic takeover, okay? Some great examples are like with the US and Iran. They haven't really taken over Iran yet. And with Venezuela, They haven't really done a physical takeover of those countries yet, but they've heavily destabilized the economies of those countries because they put sanctions on those countries' oil supply and exporting of oil, which is going to impact the economic activity and revenue of those countries. So now major players around the world are not doing oil business with these countries because of the sanctions being put on by these big players. So then overall, from an economic front, as the months and years go by, these countries eventually collapse within themselves. And majority of these countries are already most likely following some type of corrupt government dictatorship and was already very unstable. But even though they were unstable, they had the potential with the resources, with how resource rich they are, and with their outlook that they wanted to achieve, to be very big global players and be very economically wealthy and rich. But obviously, other countries do not want that themselves. Why would Saudi Arabia and the US want that extra competition? You know what I mean? So the way you see economic destabilization is through like sanctions. And then you also see other countries such as Afghanistan, Libya, and so forth that actually get physically raided. You have war. And besides the impact on oil, and besides the fact that it's usually because of oil power and control, war itself is extremely profitable. And you need oil to fuel the war. It's like a circle that it's like a beautiful circle that just feeds itself, that makes the rich even richer at the cost and sacrifice of people's lives. You know what I mean? So like through war, oil price goes up. It's even better for them. They love it. So majority of war and conflict is literally over the control of oil supply or demand. So it might not always be trying to take over a country's oil supply. Sometimes other countries have great positioning and access to various shipping routes. Like Iran isn't just oil rich, they also control the Strait of Hormuz, which is a major oil shipping route, right? Having control of that is a major power move. So some countries just are positioned with having better access to certain shipping routes or whatever it may be in that sense. And countries want to take that over or have control of those ports and areas. You're seeing China taking over tons of ports within Asia, Africa, and starting to take over countries on an economic front. Okay. And war in itself impacts economies, people, and prices. So global impacting factors on crude oil, global supply and demand. Remember, oil is an actively used resource, whether it's refined into gasoline to put in your car, or it's used in manufacturing and industry or heating and electricity, whatever it may be. Oil in itself is actively mined from the earth, refined into its various products and consumed and used, right? So there's the production and consumption there. So the global supply and demand is a major impacting factor, which of course leads into the production and manufacturing, right? What we saw happen and the pandemic was absolutely great because it helped us learn so much and confirm so many of these topics and concepts, right? When oil crashed and the crude oil price went into negative integers, it's because you were having a huge impact on the supply, demand, production, and manufacturing, right? Production and manufacturing in these various industries pretty much went dead because you have global lockdowns, right? Demand around the world went dead. You have billions of cars off the road, people off work, global lockdowns. Supply went through the roof as you had a huge over storage, huge oversupply, right? So you have a huge supply, you have a dead demand, you have dead production in manufacturing, the economic activity in crude oil for that period's dead. What happened to the price of it? Absolutely went negative. We saw history be made and crude oil go to negative $40 until those future contracts were picked up by some company that had a place to store the oil, and they got to make the money on that huge difference in oil price. -40, all the way up to almost $100 a barrel where we're sitting at now. And on the flip side, why is oil at $100 a barrel right now? Well, you had the factors here. So let's just go through the list. Global supply and demand, production and manufacturing, OPEC oil cartel. Majority of major oil players that are a part of this oil cartel that dictate production levels, supply levels, price points, and so forth, and work hand in hand. War, price tensions. There's been tensions with war. There's been oil price wars before, and so forth. Interest rates and inflation, because at the end of the day, this is an investment vehicle and trading instrument. There is money being made on the price changes of oil at the end of the day. Global import and export, market fear, uncertainty, and doubt, investor order flow movement, and based on the above points. Something else I forgot to include. You know what's also really interesting? You know, for gold's production and mining costs, when oil prices go up and keep continuing up, gold's production and mining costs also go up as well, which can be a bullish factor for keeping gold price a bit more bullish because it's costing more now to mine it. So they're going to have to make that difference in price when they sell it. Right? It's not a huge contributing factor to the price, but something really cool when you understand these correlations. As oil price goes up and oil's used in these various industries, oil is used in the manufacturing, oil is used in the mining and production process of gold, right? So it increases the production and mining costs to an extent. It's just like when you had housing prices going up. Yes, housing prices were going up because low interest rates, inflation, and that in itself, but other material goods to build the houses were also going up. The commodities such as lumber, copper, the other metals and materials that go into building a home, right? So the production and building cost of a home was also going up at that time, which is going to contribute to the price increase. This is sort of a similar type of understanding. Okay. So understanding that, we can easily see and deduct why oil price had that heavy downfall. You had a huge oversupply, huge overstorage, dead global demand, dead production and manufacturing. But then why is oil back to $100 a barrel? Well, global supply got regulated when OPEC came in and decreased production levels at the start of the pandemic. Then we saw majority of major players around the world come out of lockdown, huge surge in demand, huge surge in production and manufacturing. As an investment vehicle, after the crash, oil was conveniently at very low prices. So you have that huge flow of order flow. You have that huge inflow of equity, right? Liquidity, buy side liquidity, buyer order flow, on top of low interest rates and rising inflation, right? So you can see the impacting factors and the impact it had on the price on the buy side and sell side. US dollar. A lot of us trade US dollar pairs, UJ, Euro USD, GBP USD, whatever it may be. But understanding the individual impacting factors on the dollar is very, very critical. The reason for this is because of the status the dollar holds. Okay, so the US dollar with the crown on it, the global business currency. You don't see majority of import and export being done in Indian rupees or the Chinese yuan or the Japanese yen or in the German franc or in the Canadian dollar or in a smaller African currency. No. You see majority of global business being done within the means of the US dollar. This gives a lot of power to the US dollar on a global scale, and the US does whatever it can to maintain this status, right? So the US dollar hold status as the petrodollar, working in hand with Saudi Arabia for that oil control, global business currency, and even as a safe haven currency on a global scale due to the corrupt economic ventures of the US through history to maintain power and control. Various war ventures, central banking, control over oil, and so forth, and the economic power they have built over the years and the power they hold on the global stage there. Okay. So when you understand that, understanding the US dollar movement is critical when trading any dollar pairs. At the end of the day, the US dollar is the fiat currency and the currency of the US economy. This has major impact in the real world as every single person who is going to work is working for this dollar. Before they even work, they're going to school and their parents or they're taking a loan to pay for school with the dollar, to eventually get a job to get paid this dollar, to use this dollar and pay their bills, to use the excess of this dollar and eventually invest. Understanding how this dollar is formed, where it comes from, where its value, how its value is determined, the impacting factors can be useful information outside of trading in itself. Okay. Now, the US dollar has been away from having any backing for a very long period of time. Currencies used to be backed by gold, like I was talking about in the gold breakdown. At one point in time, you could only have so much currency in circulation within an economy dependent on how much gold that country was hoarding to back the value of the currency in circulation. That was eventually broken off years and years ago, and we came into this more of a trust-based system where we trust the laws, legalities, the information, the metrics, the supply and demand, the intentions of the government's central banking and so forth, right? Majority of people don't ask. They don't know about the value of the dollar. They don't know where it comes from. They just know they get paid this. They got to make their money and they got to pay their rent and pay their bills. At the end of the day, yes, the US dollar does have some ties and in terms of its value to the condition of the US economy, to the various assets that the US government owns and so forth. But those assets, those ties to the US economic status don't back the value of the dollar, right? Like the amount of real estate or land or assets that the government owns doesn't dictate the amount of currency that can be printed. That is absolutely imaginary. That is literally up to the preference and choice of these government officials, leaders, and central bankers with their intentions in mind, right? So at the end of the day, as sad as this may be, the US dollar is fugazi. It's fugazi. It's imaginary. It's literally a digit on a screen. They increase the supply as they wish. When we saw the US money supply increase, there was no validation or reason for this increase. They didn't have to increase the US money supply this much. They didn't need to increase it this much to help the economy, right? They don't need to show, hey, we have this much gold or we have this many assets to validate the increase in money supply. They just did it, right? And the increase in money supply is not actual printing. It's just a digit on a screen. Went from the trillions of dollars in increase, never seen before in history, Okay. So what does that mean? The main impacting factors on the US dollar at the end of the day is going to be its supply and demand. Well, you have to ask yourself, who dictates the supply? Well, it's not backed by anything. It doesn't matter how much gold the US have. That doesn't dictate the supply or value. It doesn't matter how many assets the US has. That doesn't dictate the supply or value. The government and central bank dictates the supply and value. Right? So when they exponentially increase the US money supply to take that money supply and flood the stock markets and flood the housing market and flood these other asset classes like commodities and make them even richer, what you saw happen was a drop in the value of the dollar in the short term because you have a high supply and a low demand. The demand is not in the dollar at the time. The demand is in those other asset classes. So the Federal Reserve and government, of course, working hand in hand, major impacting factor directly on the supply and demand of the US dollar. Their policy plans and spending plans, their dictation of the interest rates and supply of the dollar is going to also impact investor demand down the line. So that's number one. Okay. Number two, I would say, because it's obviously a currency reflecting the US economy, the actual economic activity within the US and the economic status is going to hold some weight to the impacting factors. Inflation, which is a byproduct of the central bank and government policy positioning on monetary policy. It's, of course, an investment vehicle and trading instrument. When you don't have the Federal Reserve impacting the supply of the dollar during times of fear, uncertainty, and doubt, it is treated as a safe haven currency. You will notice if you look at the dollar movement before the right when the pandemic happened, if you go look at March 2020, right, on the dollar index chart, before the Feds increased the money supply, you're going to see that the dollar index was actually pushing up aggressively bullish. This is because before the Feds took any action, before they increased the money supply, you saw an inflow of order flow in the dollar because investors were treating it as a safe haven currency, and you had mass fear with the pandemic. So dollar initially exploded in value. Then the Feds jumped in and increased money supply, and that takes over and holds more weight, and you saw it melt. Okay. We saw these direct impacts on the US dollar through the last 2 years. We've seen the impact 2008 financial crash and so forth. All of these impacting factors, you can go and back test on the charts, line up the technicals with the fundamentals on a higher time frame perspective, on an intraday perspective, and so forth. Okay. Last but not least, a lot of us manual retail traders love to trade Japanese yen pairs, something we were introduced to through our brokers, mentors, services, whatever it may be, whether it's Euro JPY, AUD JPY, GBP JPY, like we focus on in Capital Hungry. But understanding the yen individually is a major catalyst that you can use to benefit your trading. So the Japanese yen, aka JPY. Since the post-war era and central banking hit Japan, the yen has been treated differently on a global scale due to its economic and debt structure setup. If you want more information of this, I suggest and on central banking overall, I suggest watching the documentary you can find on YouTube about central banking, but talks about Japan post-war era. And you're going to see very strong similarities and repetition in history to even what was going on over the pandemic or the previous financial crash. That documentary is called Princes of the Yen. Okay. With the economic and debt structure set up in Japan, they keep negative interest rates to prevent the yen from over strengthening and impacting the import and export business. One of Japan's main revenue sources as a smaller country and still maintaining its power on the global stage is its import and export. And what makes the import and export so favorable for other countries with Japan is that the Japanese yen is relatively kept weaker in value due to lower interest rates. Now, because the majority of the time the yen is kept weaker in value and has low interest rates, this makes it a great safe haven currency because during times of economic fear and doubt, it's at lower prices and lower rates. It makes it favorable to hedge risk and pool into the Japanese yen. They keep negative rates and they don't, and with their economic activity and structure setup, in their debt structure setup, they prefer a weaker Japanese yen as it promotes better import and export activity. Does that make sense for everybody? Right? So because of the debt structure, like it goes in a line like this. Let me explain it again. Because of the debt structure setup and the economic setup in Japan, they keep negative interest rates and low interest rates to keep the Japanese yen weaker. That's step one, right? This means overall through economic cycles, the Japanese yen and Japan overall stays in negative interest rates and the price of the yen is relatively lower. Okay? This makes it very favorable during times of fear, uncertainty, and doubt to hedge risk and pool into the Japanese yen because it's at lower prices majority of the time and at lower rates, which makes it more favorable to pool liquidity into the yen and hold for an extended period of time because of the lower rates and lower prices and because of the debt structure set up in Japan and negative rates. That's what makes it a safe haven for investors and smart money. That's what makes it such a major catalyst of the market sentiment factor on higher time frame and intraday movement. Right? For more information about what fucked up Japan's economy and had them go into that area of where they have to keep rates negative, which isn't an ideal situation, watch Princes of the Yen. That's too much to talk about in this one webinar. Okay. So impacting factors on the Japanese yen movement. Of course, Bank of Japan monetary policy, but 99.9% of the time, they're keeping interest rates low. They're keeping them in the negatives. The major factors are the global geopolitical issues, which impact market sentiment because the yen on a global scale is treated as a safe haven currency for those reasons stated. And of course, Japan's import and export activity, which can impact Japanese yen value against on a global scale as well. These ones being the common denominators of it being an investment vehicle in itself, the smart money order flow movement, primarily based on market sentiment factors as a safe haven currency. That's why no matter what was going on, you can say AJ, EJ, NJ, GJ, the yen pairs, you can say they're all different pairs. The common denominator is the Japanese yen. Over the last 2 years, when the fear of the pandemic was priced in, and then you had more market optimism, which kept the yen more bearish, all of those pairs trended the same. EJ, GJ, CJ, NJ, they all trended bullish. Not exactly the same, but the intraday market structure was primarily the same. Does that make sense for everybody? Okay. Last but not least, the global stock markets, but we're not looking at the individual company stocks. We're looking at the overall index, which houses the stocks. It is honestly, through my experience, just a market for the rich to get richer. The stock markets are built up of a collection of companies that operate across industries within a country's economy. The stock market value should be correlated to overall economic performance of the companies housed within the index. Sorry about the messed up grammar here. Of the companies housed within the index, the companies housing companies within the index. But as history shows, that is not the case. It's originally meant for, of course, investing purposes, but also to help companies grow and develop, further in turn leading to stronger economic growth. But greed and corruption destroyed that very fast. What we have seen is that the stock market is not correlated to actual company performance. The stock market is a man-made investment vehicle that is literally created to extend your wealth and make money. Besides the economic cycles of crash that come based on various catalysts throughout history, like when you had the crash in the 1980s, the 2008 financial crash, the 2020 pandemic. Besides those corrections and crashes that really just set up better price points for the rich, the stock markets overall around the world have been primarily bullish in major countries since they have first formed. You know what I mean? So some impacting factors to understand is that it is a man-made market, an investment vehicle. It is primarily created to go up. You can't have, if the stock markets actually, let's think about this. How much actually rides on global stock markets? Smart money investments, corporation values, like the valuation of corporations. The amount of money that corporations actually make is directly tied into the stock market. Majority of investors in companies through the stock market. Majority of payment is through shares and so forth. The stock market houses companies from industries across the economy, pharmaceuticals and healthcare, energy and commodities, education, big media, entertainment, finance, banking, everything. If the stock market actually crashed, the entire economy would be in a depression and crash. All of those companies would go belly under that are housed within. How those companies would be done? Their stock value zero, the company zero. What's left? Do you understand what I'm saying? So stock markets are designed historically to go up. The crashes and crisis that they show to the mainstream media is simply just to set up better price points for the rich to continue their rally forward, right? So major impacting factors to understand is that overall, historically, stocks only go up. Interest rates and price points in terms of economic cycles play a major factor. Inflation and central bank policy positioning, and of course, investor order flow riding those waves. The whole purpose of the stock market is to make a profit and extend wealth. Okay. But anyways, everybody, that's it for today. Hopefully you guys enjoy this type of presentation, little bit of PowerPoint, change it up here and there from just looking at the charts. If you bring this in line with the other educational webinars that are in the vault, it'll help you bring some more information together and connect the dots and have a better understanding of what's going on in the world, global economies, and so forth. Now, this isn't a macroeconomic lesson. We could rant for hours and do the same type of breakdown on the housing market, on bonds, on other currencies, and so forth. But this is primarily focused on the trading instruments and asset classes that we actively analyze and trade day in and day out, and how we can use this information to our advantage. Okay, so I'm going to save and upload this and process it to Vimeo. Might even upload it to YouTube. Most people won't even, like, you know what I mean? But we'll see how it goes.